Good morning everyone and welcome back to Morning Markets here at True Potential. It's Tuesday the 7th of November. Today we're going to reflect on interest rate policy beyond the UK in parts of Asia such as Japan and Australia, and also what comments from the Chief Economist of the Bank of England likely mean for the path of interest rates here next year. So if we reflect on the jobs market data from the US, it really corroborates what the Federal Reserve had communicated previously, that interest rate policy in the US has largely peaked. The jobs data on Friday saw another small rise in unemployment, and that's a 0.5 percentage point rise since April. So we are seeing genuine cooling in the jobs market in the US, whereas in the UK, data from HMRC over the last few months indicates we're actually seeing job losses, and job losses would be greater if it wasn't for public sector job growth here. So, central banks in the Eurozone, the UK and in the US can largely be confident that interest rate policy is now tight enough and that the balance of risks are perhaps more two-sided going into 2024. But where we are seeing interest rates go up is Australia. We had another hike from the Reserve Bank of Australia overnight to 4.35%. And again, that's because of continuing inflation pressures and very low unemployment, unusually so in Australia. We're also seeing rising interest rates in Japan, but through this yield curve control mechanism where they're effectively raising interest rates on bond yields, not on policy rates. So if we take this all back, we're in a more advanced setting for interest rates here in the UK, and that was reflected by Chief Economist Hugh Pill overnight, where he reflected that interest rate policy in the 10 years prior to COVID was exceptional, and so too is interest rate policy today, and that interest rates are at a more natural level, likely lie in between 0 and 5%. And that on the balance of risks, he believes we could see some interest rate cuts next year. However, there needs to be no further surprises from places like the oil market or wage data, and they likely do need to see further weakness in unemployment. So if we tie that all together, what does it mean for the UK? Well, we're likely to see continued weaker jobs growth because the private sector is now reacting to higher wages and to weaker demand. And that does feed out from some of the forecasts from the Bank of England where they expect only modest growth this year, something below 0.5 percentage points, and then next year growth of close to 0. And that's because they do expect the economy's interest rate sensitivity to increase, even though they are not increasing interest rates. There will be more mortgage holders remortgaging next year, doing so into policy rates which are likely close to 5%, and that of course will eat into the ability of households to spend discretionary income. So we likely see the peak impact of interest rates 12 to 18 months out, and the Bank of England will be vigilant of that in their forecasts. So, in summary, the communication from the last 7 to 10 days is that Western central banks are largely done. They expect the peak in interest rates to have passed, but that the peak in policy tightening is over the next 12 months or so, whereas central banks in Asia and sub-Asia still tackling inflation pressures and are prepared to hike. That's all for today. Take care.